All right, guys, it is 12 o'clock on the dot. Let's go ahead and get started. Thank you all for joining us today for our webinar here on how we choose stocks. As you can see, we have a panel of folks that we'll be talking with today to answer some of the questions that you have submitted and some general questions that we also put together based on some previous communication with clients and prospective clients. So we're looking forward to a really good discussion and hopefully answering some of the questions that you folks had. Again, we appreciate you carving out some time, especially during your lunch hour to join us today. So we'll make it enjoyable and very informative. So just to get started, a little bit about Fort Pitt Capital Group. This may be a little redundant for some of our current clients that are on the webinar today, but for those of you that aren't familiar with us, Fort Pitt Capital Group is a, independent investment manager and financial planner. We focus on in-house portfolio management. We also use a fiduciary approach when choosing investments for our clients. We feel that it's important, and we actually have a legal obligation as a fiduciary to always do what's in our client's best interest. So with one of the large Wall Street banks, we are a small Pittsburgh-based company. Although we have clients throughout the country, we still feel that it's important to have that small boutique-like feel when dealing with our clients. Although we do manage at this point over $4 billion in total assets. We're very focused on really high-level client service as well. We think it's obviously our number one objective is to bring good returns for our clients, to help them realize their goals and objectives in investing, but also providing high levels of service, financial planning, helping you manage all those different things that come with retirement planning, education planning, all those types of things. So it's very important to us, and we really keep a strong focus on high levels of client service. So a little bit of kind of housekeeping in regard to our webinars and how the webinar works. We have really, I would say over the past year and a half or so, focused on getting these webinars out to our clients on many different topics that we've heard from clients and prospective clients that are important to them. So we do have these webinars periodically. I think now we're having one every couple of weeks or so. So if you register for this webinar, you will continue to get notifications about upcoming webinars that we have on different topics. So please feel free to join us for those in the future. Additionally, all of our webinars are, once the live version is completed, they are housed on our website that, you can go to our website and view past webinars. If there's a particular topic that you want to look into, we have all those webinars available on our website for you to view on demand. So a little bit about myself. I always laugh when I have to talk about myself. It's kind of odd, but anyway, a little bit about myself. I've been an advisor for going on 13 years now, with Fort Pitt Capital Group for going on 5 years. My main focus with my clients is just really helping them achieve all of their financial goals, doing that the most efficient way possible, providing proactive advice on all types of different financial planning topics. We at Fort Pitt like to be your #1 financial resource for anything financial. If you're looking to refinance your house, or you're looking to, how do you fund your children's education, all those types of things, we want our clients to be talking with us about that, and providing guidance on how to best do that. A little bit on, the personal side of things. I do have 2 young daughters and a third on the way next month, actually. So that keeps me pretty much occupied outside of work. Not much time for anything else besides that. But it's great getting to spend time with them and watching them grow up. So it definitely takes up all the free time that I have. So let's talk a little bit about our presenters here today. I'll essentially just be leading the discussion, and these gentlemen here will be kind of fielding the questions and talking a little more specifically about how we do what we do. First, we have Dan I, who's our Chief Investment Officer. So Dan's job at a high level is kind of setting the overall investment style and strategy that we run for our clients. We do have multiple strategies that we employ for our clients, and at a high level, Dan kind of oversees all that. He's also involved in the day-to-day research on the different companies and investments that we choose for our clients. So Dan does a great job for us and for our clients, and we're really happy to have him as a member of the team. Carter Henderson is one of our portfolio managers. Carter also does similarly to Dan in focusing on researching our different investments that we use, monitoring those investments, and making decisions on holding, selling, buying, all those types of things. Carter also works a lot with endowments, foundations, and pension funds. Carter's been on board with Fort Pitt Capital for several years now and a valued member of the team, so we're happy to have him with us today as well. And then last but not least, we have Mr. Charlie Smith with us today. Charlie's one of our founding partners back in 1996 when Fort Pitt Capital became Fort Pitt Capital. So Charlie obviously has a wealth of experience and knowledge in investing in the markets over the years, and has done a great job throughout his tenure with providing great recommendations and advice to all of our clients. So very happy to have you 3 on the panel here today. Thank you for being with us. So let's get into the questions. Let's get into the meat of the discussion here. We have, again, as I mentioned, some questions that we've already put together, and then some that have come through actually this morning and yesterday that we'll also address. The first question that we have is for Charlie Smith. Charlie, this question is about how we manage risk when owning a portfolio of stocks. Would you oblige us to answering that question?
Sure, Chuck. Thanks for having me, and welcome to the team. Really, this question is the most important question when you want to be an investor, because the way our society is structured, people go into business to try to add value, and there are millions of people in business today trying to add value to their enterprises, and so the returns, in a sense, are out there. It's our job as investment managers to capture those returns in a way which allows our clients to sleep at night. Our job is to capture the equity premium, which is the premium return that comes from being a business owner. In our case, the businesses that we own are listed on a public exchange, so we can gain access to them very, very inexpensively and very readily. But in a sense, those returns are out there, and we are truly risk managers. We want to capture those returns in a way that allows our clients to be comfortable. And as an investment manager, we've learned over the years that successful investing is often about purposely making yourself uncomfortable and taking on risk and managing risk. And so to us, the risk part of the equation is the much more important factor in the equation. And to us, the most significant way to manage risk is to be price sensitive. the risk is always in the price that you pay for an investment. And if you think about it, there is no risk that you can't discount if you pay a low enough price for an investment relative to the expected earning stream that you're buying. So to our minds, the risk equation is really solved by being certain that we're paying a reasonable price for the investments that we own. We always own decent quality investments, and we try to own investments where management's incentives are directly aligned with ours as shareholders. But to us, the risk is always in the price. And if we can find a decent business, a consistently well-run business that has a track record of generating above market equity returns at a market discount, that's the ideal. Obviously, we're not going to be able to find the very best companies at significant discounts, but we want to remove the risk of the future not turning out the way we expect as much as possible. And we believe the best way to do that is having a value discipline, that is being concerned about value. And finally, if you want to think about the value investing approach and the growth investing approach, we would describe growth investing as making a guess about the future and oftentimes being willing to pay a premium price to make a guess about future growth. Whereas value, we define as understanding what a business is worth today, not necessarily making projections into the future, but understanding what a business is worth today and then being patient enough to pay a reasonable price for it. We think the value approach is inherently less risky than the growth approach. Each one can work, but it not only takes a different mindset to be a growth and a value investor, but it helps to know who you are. And as an old Scotsman who is just sort of inherently very cheap, we're all about price in our management and control of risk in the investment process.
Thanks, Charlie. You know, one thing that I've learned from you over the years that, you know, you've always kind of conveyed when talking about this that I think really resonates with clients is, you know, we want to invest in stocks because we want growth. You know, inflation is real, and you know, the money that you have today is going to buy you a certain amount of goods and services today, but those goods and services 10, 15, 20 years down the road are going to be more expensive. So we have to grow the money. So, you know, that's why we like to use stocks, but it's important, you know, for people to understand that those returns and that growth doesn't come in a straight line like it would if you were investing in, you know, CDs or bonds or something like that. So that's kind of the give and take of investing in stocks is, you know, you're not going to have a straight line return. There's going to be a little volatility, but over the long run, you know, you're going to make a better return by investing in equities.
Absolutely right. You want to minimize the risk in the process by recognizing that the returns are not going to happen in a linear way. And the human element in investing is going to drive market prices to places almost that you can't even imagine. But you can't be focused on that. You have to be focused on the business and the returns the business is generating rather than the emotion-driven day-to-day trading in the marketplace.
Great. Thank you, Charlie.
Hey, John,
Yeah.
before we move on to the next question, I think, you know, I would add too, for client portfolios specific to, you know, portfolio composition and how we think about risk too is, you know, position sizing is something that we take into consideration where, you know, generally we step in with a 3% position, but, you know, we don't, if that stock is a home run and it takes up a bigger chunk of the portfolio over time, you know, we want to not eliminate that risk, but pare it back and make sure that one position isn't growing to become too large of a portfolio. And then also too is, you know, sector risk, right? And we think about how different sectors are affected by, you know, different macroeconomic outcomes in the market. So, you know, limiting our exposure or making sure we're not drifted too far away in one certain sector or overexposed, you know, for our portfolios.
Yeah, great point, Carter. Absolutely. And it just kind of boils back down to, you know, diversification through the portfolio. You know, no company's bulletproof. That's another phrase that Charlie has bestowed upon me throughout the years. So we know that, and knowing that, we don't want to take too much of a quote unquote bet on any one company. We want to have diversification across multiple businesses. So yeah, great. Thank you guys for that. Okay, moving on to the next question here. Sorry about that, went one too far. Next question, what are the advantages and disadvantages of investing in individual stocks, and why wouldn't we just invest in mutual funds instead of individual stocks? Who wants to take that?
Yeah, I'll go ahead and take this one. I'll take this one, Chuck. Yeah, thank you for the question. I think the first thing that comes to mind for me as advantages in stocks is taxes, right? So as an individual, investing in individual stocks, you can better control when you pay taxes rather than being at the mercy, of a fund company and when they want to sell stocks. Another advantage that comes to mind is, reducing a management fee. You don't have to pay the fund company or a third-party investor an annual management fee for investing your assets. And then, the last advantage I'll hit on is tradability. So, with stocks, you can trade in and out of a stock at any time during the day, and you know exactly what price you're going to get after execution. Whereas with a mutual fund, you cannot trade intraday, and you have to wait until the end of the day to get the final price or the net asset value. Now, on the flip side of that, I think some of the bigger disadvantages, I think if you're looking for diversification, it probably, will take a lot less capital and a lot less effort to get diversification through mutual funds than you would through, say, individual stocks. And then, I would say the time that you put in, right, it requires a lot more time to monitor, a lot more due diligence to owning individual stocks over mutual funds as well.
Right. Yeah, great points, Carter. And the other thing too, to I think touch on is we have the talent and infrastructure in our firm to manage individual securities. Not a lot of other firms can do that in-house because they don't have the talent or the tools to do so. Fort Pitt has invested a lot of capital in building out a great infrastructure for us to be able to do this. And we have an 8-person portfolio management team to help execute these strategies for us. So I think that's another reason why we're able to do that as well. So question number 3, what types of stocks or companies does Fort Pitt like to invest in?
Chuck, I'll grab this one. And I'd say, Carter, Charlie, and I all have slightly different approaches, but I tend to have a strong preference for high quality companies with strategic advantages. And when I talk about strategic advantages, I mean things like an iconic brand, a superior product or service, or intellectual property or know-how that competitors just don't have. I also like companies that generate a lot of cash and high levels of free cash flow, which allows a business to do things like reinvest back into the company for future growth, to make attractive acquisitions, to increase dividend payments. We like to invest in companies that generate high levels of return on equity, which is just a good measure of how efficiently a business is able to generate returns with their shareholders' capital. And as Charlie already hit on, valuation is a really important component of our stock selection process. So frankly, it's not extremely difficult to find companies with attractive growth rates and solid prospects for future growth. But we think it's just critically important to pay the right price for those businesses. And for by the right price, I mean buying a stock at a valuation where the probabilities for success or for attractive future returns are skewed heavily in the investor's favor. And quite frankly, that often requires some discipline and some patience.
Yeah, I would add that I believe in my career that the biggest mistake that the retail investor makes is to be unwilling to be patient enough to buy what is demonstrably a good business at a reasonable price. People overpay generally for the businesses that they own, mostly because the herd behavior kicks in and people feel like they need to be part of the group. And again, that's one of the psychological aspects of investing that you need to be aware of.
Great. Thanks, guys. Good insight there. Okay, next question. Okay, how do dividends factor into the process of evaluating companies?
Yeah, so our preference for dividends is really determined by the growth rate of a business. So for high growth companies with opportunities to reinvest their cash and to earn attractive rates of return on that cash, we'd much rather have those businesses redeploy that cash on their own, as opposed to returning it to us as shareholders in the form of a dividend. But for more mature companies with lower growth profiles and limited opportunities to earn those attractive rates of return, that's where we do have a preference for dividends. And in those cases, we like companies that have also have a strong track record of dividend growth, and have shown the ability to consistently increase their dividend payments to investors on an annual basis. That ability to consistently hike the dividend payment, that's generally corresponded or correlated very well with companies that have a very strong balance sheet, a strong financial position, and a really successful business model.
Great. So essentially, we like companies that pay dividends and companies that don't. It just kind of depends on the individual business and what we're looking at kind of long term. So a portfolio of stocks that we buy for our clients will include some companies that are dividend payers and some that aren't. Great. Okay. Let's move on to the next question here. All right, so talking a little bit about research, what type of research does Fort Pitt do when evaluating buying a stock? So what type of research does our team employ when we want to possibly buy a stock?
Yeah, Chuck, I'll go ahead and take this question. And I think, what's great about Fort Pitt is that, my research process is different from Charlie's and different from Dan's. So we all bring a kind of unique proposition into the stocks that we're choosing. But, I think we all use a simple process or a similar process. And it's really two types of research, and that's qualitative and then a quantitative approach. So when I look at it from a qualitative standpoint, that involves talking with management teams, customers, suppliers, anyone across the supply chain to get a better understanding of the company. And then having a deep understanding of the product or service that company offers. I think almost all of the companies that I've put in the portfolio either own the product or have interacted with the service in some way. It helps me better understand, what is driving the consumer behind the company. And then also with qualitative, that involves, what Dan alluded to earlier, understanding why this specific company has a unique advantage over their competitors. This could be technology that they've implemented. This could be just great brand recognition, or it could be a unique selling proposition. And then after I get a pretty good handle of the qualitative aspects of the company, that's when I dive deeper into, more quantitative aspects of the company. So looking deeper into the numbers, does the company have higher profit margins than competitors, meaning they have some sort of pricing power? Does the company have better cash flow metrics? Are they more operationally efficient? And then kind of my last steps will be, running a discounted cash flow model to try and get an accurate valuation of the company. And, all a DCF is basically trying to forecast future cash flows of the company and then discounting them back to the present to try to get an accurate valuation.
Right. Great. Thanks, Carter. So essentially what we're doing is, initially looking at what does this company do? What types of products or services do they offer? And evaluating, what we feel about, those particular offerings. And then, from there, we're really kind of diving into the numbers and looking at, profitability and, what's a good price to buy this particular company at, if you will. So it's kind of both sides of the coin, if you will, that we look at when evaluating different companies.
Chuck, we're looking for a sustainable competitive advantage at a reasonable price.
Great. Awesome. Thanks, guys. Okay, moving on to the next question. Okay, this is a good one. This kind of all ties back into a little bit with research. Are all of the stocks that clients own tracked? And if so, how are they tracked and how frequently?
Yeah, Chuck, I'll go ahead and take this one as well, but I would say yes, definitely all of our stocks are tracked. I mean, our goal is to understand these businesses as well as the owners do. And, in order for us to do this, it's a daily task to stay up to, with the latest news from our companies, and whether that be earnings calls, analyst calls, investor presentations, conferences, new product releases, whatever it is, we're tuned in. And even when I first joined the team, some of the portfolio companies, I even traveled to their headquarters, sat down with the CFO and the CEO and talked about, their goals for the business, what they see over the next 5 years. And that's where you get really good insight into these businesses. And that's led to us making some really good decisions on our portfolio.
Great. Yeah, I get this question a lot from prospective clients. Are you watching our account on a daily basis? Are you, watching our investments on a daily basis? And, I can honestly answer that question with yes. We don't necessarily look at down to the individual level, but all of the investments that our clients own in their accounts are followed and tracked daily, and that's why we have this talented team of professionals and the resources that we have, so that we're able to do that. And we don't have to, farm this out to a third party. We can actually do it in-house. So yeah, so this is something that is, followed and tracked on a daily basis. So good answer, Carter. Thank you.
Chuck, that also asks the question, what happens when a client comes in with a portfolio of maybe 100 stocks where Fort Pitt might have current ownership in only 10 or 20 of them? The names that we don't own in our current portfolio and are not current on, we're going to do an initial evaluation of every single one of them to decide if there's an immediate risk involved in owning shares of this business. And we're going to decide either to fish or cut bait with that position right away. So a client that comes in with a full-fledged portfolio, we are going to decide, do we like this business? Is it reasonably priced? Should we keep it? And typically the way it works out is a third of the names that come to us as a new position, we're going to like and probably keep. A third we're not going to like and probably sell within the first few months. And then there's another third in the middle that we're probably going to want to do some further work on and then make a decision on a buy or sell later.
Yeah, good point, Charlie. And that's, I think, a big advantage, that we have, again, with our infrastructure, is that, if a prospective client comes to us and they already have this fully built out portfolio, we don't just wipe it out day one and start fresh with all of the investments that, that we like. We can do it over time. We can hang on to some of the investments that, we do like, but it's not necessarily a full-fledged, sell out of everything and start fresh. So it's a little bit of a unique approach that we can offer, to clients that already have a portfolio that's built out. So great, thank you. Okay, number 7, what drives our decision to sell stocks?
Yeah, Chuck, I'll jump in here. So I'd say we sell stocks for three main reasons. And first, I think, Carter kind of alluded to this already, but, the stock has performed really well, and the position size in the portfolio has grown to a level where, we feel it's prudent to sell a portion of that stock, for risk management purposes. Or, the stock has done extremely well, has reached our target price, and we no longer feel that the company is undervalued and time to take our profits and move on. I'd say the second would be when we made the decision that our original thesis for investing in the company is no longer valid or has been greatly diminished, or put maybe more simply, we're wrong. We aren't always right, no one is, but it's extremely important for investors to have that discipline to know, when they're wrong, and to be able to take losses, to be able to move on, and to hopefully, learn something in the process. And I'd say the third reason would be, when we feel there's just a more attractive opportunity and need to sell a stock in order to, capitalize on that buying opportunity.
Yeah, great answer, Dan. I think you've mentioned this to me before, and we've talked. I think ideally, what we'd like to do in a perfect world is, buy a portfolio of stocks and hang on to those stocks for 5 to 10 years, and just as they grow, take profits along the way. It doesn't always happen that way, but we want to try and buy, good companies that we can hang on to, for a long time, and allow that stock to appreciate. So, I think that's the objective there. It's not to really churn the account and buy and sell in and out of stocks, continuously. It's really to have the discipline to stick with a company, even through, a bad time. And again, if there's, reason for us to kind of make a change or move on, then we'll do that. But, we're also not afraid to stick with a company through, a tough period of time if we feel like, they're going to come out, stronger on the other end. So.
Right. And we're certainly disciplined, long-term investors with, low turnover in portfolios. But I think that kind of outlines some of the fundamental reasons that we would make a change.
Yeah, great.
Just a final little bit of color here. Our average holding period for the businesses we've owned in portfolios at Fort Pitt Capital is over 11 years. So we certainly are owners of the businesses that we're involved with. We're not traders. We're not fast money. We want to build a portfolio of well-run businesses at reasonable prices and hold on to them. Ideally, our clients pay millions of dollars in long-term capital gain taxes. We're going to defer those taxes as far out as we can. Hopefully, we can defer them for decades, but that's really the goal in this process.
Great. Excellent. Thanks, guys. Okay, number 8. What size portfolio does a client need to have to invest in a portfolio of individual stocks?
Yeah, Chuck, I'll go ahead and take this question. Yeah, I think over the years, technology has really helped lower this number. You have fractional share buying and, no more commissions at the large custodians. So, here at Fort Pitt, we generally would like to see a stock account have at least 150,000 in assets to begin with. This way we have ample room to diversify the account and, not have to worry about, any looming distributions that are coming up, kind of messing up our position sizing or kind of ruining the diversification that we've built out.
Great. Yeah, I mean, I can say, I've seen that change in the period of time that I've been here at Fort Pitt. We've had the ability through technology to be able to offer, the stock portfolio to, accounts that are, not as large as we had required, I guess, in the past. So it's a nice benefit, to be able to offer the stock portfolio to many different clients out there. So great. Okay, question number 9. We have been fairly aggressive in our stock bond mix, but we're close to retirement. Do you feel it is time to move closer to a 60-40 mix as we enter our retirement years? So this client is asking, do they need to pare back their risk as they move closer to their retirement years, specifically a 60% equity, 40% bond or fixed income type of portfolio?
I'll take this one, Chuck, and feel free to jump in here. But I'd say what I really like about our process and our structure is, the answer to that question isn't just driven by the investment team's outlook on stocks versus bonds. It's also determined by the work that our advisors do, really to understand each client's unique circumstances and their objectives, and the financial planning work that we do really at the beginning of each relationships that helps to dial in on the most efficient asset allocation strategy for each client. So I think the answer to the question is it depends, and I'd say it depends heavily on how dependent the investor is on the portfolio for day-to-day living expenses. If they have entered retirement and are living off the portfolio, it may make some sense to have some exposure to less volatile asset classes like bonds and cash that can be used for liquidity purposes, especially in times of market stress. I wouldn't want to be in a position where we were forced into selling stocks in the middle of a severe correction like we experienced last spring. But other than being that liquidity source, it's very difficult to really ascribe any real value to bonds in the current environment. Bond yields are at or very close to all-time historic lows, and once you adjust for inflation, yields on any type of high-quality bonds are in negative territory. So in isolation and with a reasonable time horizon, we lean heavily towards the equity side of that equation and earn that risk premium that Charlie outlined. But again, I think an understanding of each investor's circumstances would really be required to give an extremely well-informed answer to the question.
Yeah, great answer, Dan. And this is another reason why at Fort Pitt you have a team that works for you. Essentially, you have the advisor, whether it be myself or one of our other advisors, and you also have the portfolio management team where we collaborate with each client. So to kind of answer this question from an advisor's perspective, there is no cookie cutter approach to how your accounts or assets should be allocated. It's to us dependent on not so much how old are you or how close are you to retirement, but when do you need income from your portfolio? How much income are you going to need from your portfolio for what period of time? And that is what really drives our decision on allocation. Again, we like investing in stocks because that's where you're going to make your best return. And we need to grow our clients' money for the long term to keep up with inflation and other things like that. So if I have a prospective client who is going to retire in a few years but isn't going to require any money from their portfolio, then my recommendation for them would be much different than somebody who's going to be retiring in a couple of years and needs a significant amount of money from their portfolio. Those clients would be allocated differently. So it really boils down to the individual client and what their income needs are. And then once we determine that, we like to build out at least 3 to 5 years worth of the client's annual income need in bonds and cash, so that if we do go through a downturn in the market while the clients are taking income, we don't really have to adjust the stock portion of the portfolio. We can get that income from the cash and bond portion of the portfolio, which tends to stay more stable, during a downturn in the market. So again, these are things that we really try to evaluate and have really good discussions with our clients or prospective clients about. When we meet regularly with our clients, we're having these discussions and kind of determining how the accounts should be allocated based on what their needs are going to be. So I appreciate it, Dan. Thank you.
Hey, Chuck, just one quick comment there. That really is something that we do differently. We don't use a percentage based on your age. We look specifically at what the client is going to need in the next few years with regard to cash from the portfolio, and we are certain to put aside 3, 5, even for more conservative investors, maybe 7 years worth of cash expenditures in cash or treasury bonds, so that if we do see a market decline, there is absolutely no need to sell any stocks. That's the outcome we want to avoid. And it really isn't as simple as some 60-40 formula.
Right. Absolutely. Yep. So again, it's very customized to the individual investor and what their needs are going to be. So thank you guys for that. Great question. Okay, number 10. When the market starts to fall significantly, how do we notify clients as to cushion the effect of a market decline?
I like that one, Chuck. I think that's a good question. So I'll take it. First, as far as notifying clients, so I think we do a really good job of communicating with our clients in general, but especially in periods of market stress or market volatility. But we're not market timers, and we're not market timers because that's an impossible game to win, or at least it's an impossible game to win consistently enough to call it a successful strategy. It always kind of irks me a little bit when people make the comment that timing the market is really hard. It's not just really hard. If it was really hard, we'd work harder and figure out how to do it. It's impossible. So we think it's really important to get our clients prepared for market volatility, and understand the importance of sticking with a well-crafted, well-established investment plan when we do hit periods of market stress. We know pullbacks and corrections are just part of investing. We know that if we look back over the last 40 plus years, the average intra-year peak to trough decline in the market is about 14%. That's an average on an annual basis. And we know that, as Charlie likes to say, twice a decade, the market goes really haywire. So we know that stress will happen. It's not a question of if, it's a given. So the real risk in our view is reacting to it, and to again abandoning an investment plan in the middle of a significant or severe market correction. Those are the types of decisions that really result in very real long-lasting impacts to investors well-established retirement plans.
Yeah, great, Dan. And I can piggyback off that a little bit too, in saying that as advisors, we're available to our clients at any time. I can speak to just back in March and April of 2020, when we went through the big decline with COVID. I was talking to clients all day long for many days, and helping explain to them what's going on and what we're going to do, and understanding that sometimes not doing anything can be the right decision. There are times where maybe we should do something, but we don't want to be reactive and make a bad decision. There were in my case a few clients that I had to talk out of making a bad decision and trying to get out of the market And if they had done that, they wouldn't have made all their money back on the upside when the market rebounded. So it's our job as advisors to, to work with you on that and to get you through those periods of time. When I'm talking with a prospective client or a current client, to your point, Dan, I don't talk about if we have a downturn in the market, it's when we have a downturn in the market, because they absolutely happen. And we know that, and we build our portfolios, to sustain those. So it's definitely something that, we want to be communicating with you on and available, to talk you through those tough times.
And Chuck, one final comment here. We have the horsepower here, the intellectual horsepower and the communications ability to help our advisors understand the process of declines and market declines. And I have to give Dan some kudos. Back in April of last year, he wrote a piece for clients called Markets Don't Wait. This is at the heat of the COVID panic. And it was absolutely correct. The markets, particularly once the Fed stepped in, we're not going to wait to recover. And someone who had, that argument in their pocket and that sort of intellectual underpinning to their market view was in a much better place than someone that really had nothing, no rock to stand on, so to speak, to try to understand what was happening in the market. So, keeping your head while all about you are losing their head is hard, but it's made easier when you have an intellectual underpinning that makes sense and is going to stand the test of time.
Right, absolutely. And the other one quick thing I would just add on is the great thing I think about having these gentlemen and ladies in our portfolio management group is that there are resources that are available to you. Dan and I, Carter and I, Charlie and I have calls with clients periodically. If they have specific concerns or questions about the markets, we're available to have those one-on-one chats with you. These guys have been great about making themselves available to do that. So, we have the folks that actually make these decisions that you could talk to if need be. So good insight, guys. Thank you. Okay, let's see. Question 11. Is Fort Pitt looking at socially responsible investing, stocks that benefit the planet, humans, animals, and nature?
Yeah, Chuck, I think since I'm the young gun of the group, I'll go ahead and take this one. I'll lead by saying we don't actively have a process, for those type of due diligence, those type of research built into our process right now, but we can accommodate portfolios that maybe don't want to hold stocks or mutual funds that are not ESG friendly. And for those who don't know what ESG stands for, that's environmental, social, and governance. What I'm seeing out there in the market right now, ESG is seeing a lot of capital inflows, and businesses are taking notice of that and changing the way they operate to become more ESG friendly. I would give an example of just look at some of the big oil companies who've committed to and are looking to become carbon neutral over the next decade. So, as the younger portfolio manager, I am kind of actively looking in this space, but that doesn't mean, myself or the team, we're looking to buy, solar companies or EV companies. I still think it's a relatively young space to invest in. As you see, new industries like this pop up, there will be thousands upon thousands of companies who try to, come and make money in this market. And then by the end of it, you'll see 3 companies who dominate the market. So it's still early in that segment for us to get good footing of what companies, those will be. But I think there is a lot of opportunity up and down the supply chain in sustainable energy, specifically, into the raw inputs going into, the new age infrastructure. So, all of those EV chargers, wind turbines, solar panels, they all have serious overlap of a few basic materials. So, I would say we're actively looking and we're looking across the whole supply chain.
Great example of a company in our portfolio today in that realm is 26, with their really are providing the supplies to create all sorts of battery technologies, solar technologies. Their laser and laser optics equipment is really key in many of the new age energy industries.
Yeah, Charlie, that brings up a good point too. I mean, I think, some of the themes of the stocks, that we hold in our portfolio has been, maybe it's not the trendy company that's getting all of the publicity, all of the news on, CNBC, but, we may own companies along that supply chain that are supplying them so they can hit that momentous growth. So, that's been a place for us and a niche that we found that's worked well.
Absolutely, Carter. And by definition, the trendy companies that are getting all the attention on CNBC are overpriced.
Great. Thanks a lot, guys. I know that's an important topic that, a lot of clients are asking about. So we appreciate your input there. I want to throw one out real quickly that came to us this morning that I can handle. A prospective client had asked, how often should we review a portfolio, and what does that process look like? So just to give you a quick idea, if you're working with an advisor at Fort Pitt Capital Group, at a minimum, we want to have a review meeting once a year, if possible in person. If not, we have the capability to do video calls and conference calls and things such as that. But that's the minimum is once a year. I can tell you, many of my clients I'm meeting, having review meetings with, twice a year, some 3-4 times a year. It's just kind of dependent on, how much contact the client wants. So, at a minimum, we're wanting to get together at least once a year just to kind of review how things have performed, reviewing, have your objectives changed since the last time we sat down, and if so, do we need to make changes to the portfolio because of that? And all of those types of things as as things change, daily. So again, it's kind of dependent on the client, but I would say for most of my clients, we're getting together about twice a year, at least to review everything and make sure we're all on the same page. But that can be determined with you and your advisor as to what makes the most sense for your particular situation. I think we have one or two more here. We're up against the stopping time here of 1 o'clock, so see if we can get this one more in. What is the volume of stocks that you purchase before you distribute them to your clients?
Yeah, Chuck, I'll go ahead and take this one as well. Really being on the trading desk, this will vary from trade to trade. Generally, given the $2 billion of equity assets that we manage, we like to have about a 3% position in our portfolio companies. So, that equates to roughly a $60 million position. And then obviously, given the range of stock price for the company, the number of shares will vary probably significantly. But I think you can also add in there too, is that most of the companies that we purchase, excuse me, are highly liquid securities. So it's not like, we're moving the market, but there has been some instances where, there's a thinly traded stock where we are.
Right. Yeah, and I think also one thing important to add is, the custodians that we work with, we have really good relationships with. So, accommodating these trades and things like that, yeah, I think I would say have been it's been easily accommodated by our custodians because we have such great relationships with them. Okay, so that brings us to we're almost at 1 o'clock. I don't want to keep any of you folks longer than we had promised at stopping at 1 o'clock here. So that will conclude the question and answer period. Gentlemen, thank you all for your time today. I really appreciate it. I think it was a great conversation. This is our second presentation of this particular topic. We did one several months back, and it was really well received. So hopefully this will be something we continue to do periodically and add different topics into it. But really appreciate your time and insight, guys, and thank you so much for sharing.
Thanks, Chuck.
Thanks, Chuck.
Yeah, thank you, Chuck.
Great. So just a couple quick things to before we close out. We do have some upcoming webinars that you can register for, a few of which you see here on the screen. So if any of these interest you, you can hop onto our website and register for some of these upcoming webinars on different topics. Again, we host these, pretty much every other week or almost every week now. So there's a lot of really great topics out there, and we encourage you to register and share with your friends. But you could do that best by hopping on our website and registering that way. And that pretty much concludes our discussion today. Again, if anybody is interested in talking a little more in detail about becoming a client, or how we would work with you as a client, please feel free to reach out to me. All of my information is here. Again, our website is kind of the best place for information as well. You can jump on there and request that somebody reach out to you. But we will also follow up with a video copy of today's webinar for you via email. But again, if you're interested in talking further about becoming a client or talking about your unique situation, please reach out. We're happy to help any way that we can. So that brings us to 1 o'clock on the dot. Thank you guys again, Charlie, Dan, and Carter, and thank you all for participating today. We really appreciate it, and enjoy the rest of your Wednesday afternoon.